Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
So nice to have you back with us, and thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can go to TomWilsonProperties.com for a lot of investor information. You can see all of our podcasts from the past 5 years and pull up the subject or guest and to be able to review the podcast at your convenience. We also have on there products that Wilson Investment Properties has available for rental investment income and commercial and multifam properties that are syndicated that you can invest in for as little as $50,000. However, you have to sign up to our newsletter so that you get a relationship with us so we can offer those products to you. Also, we welcome, of course, your questions at any time. Be glad to answer them and any suggestions you have for future topics or guests. Today we have on the program someone I just recently met, but very impressed with and glad to have him on. Victor Menasce is the principal at U.S. Real Estate Partners. He got his start as a microprocessor and system chipset designer in the mid-1980s. He took progressively more senior roles in both private and public technology companies over a 25-year career. In that time, he was involved in 3 startup companies and 5 acquisitions. 2010, he took a left turn in his career and moved into the world of real estate investing and development. Boy, it's the first time that's happened, right? Anybody go from high tech to real estate? He's been extremely active as a real estate developer in multiple markets and has specialized in raising capital for development projects since that time. He's the author of 2 books on real estate investing. Most recent is Magnetic Capital, How to Raise All the Money You Need for Any Worthy Venture, of which I'm proud to have a copy here on the desk, and look forward to reading. So, Victor, welcome to the program.
Great to be here.
So nice to have a little bit of time with you. As we were just discussing before we went on the air, we spent 8 days together in theory on the Summit at Sea, the real estate guys, but it's so jam-packed with information, it's hard to get as much individual time as we want.
What an intense week. So much learning, and we met so many great people. Caliber of people, when you're locked up on a ship for an entire week, people put a lot of money and time on the line. You really attracts a high caliber of person. So it was a wonderful, wonderful week.
I want to, I certainly agree. It's why this is my 6th time going back. And I'm a pretty high-energy guy, but when I come home, my wife is shocked to see that I'm tired. It's the only time of the year that I'm tired is after this summit. People don't understand. You go from 8 in the morning till 12 or so at night, 8 days in a row, and you don't want to miss anything, right?
Absolutely. In fact, the week before I was helping Tony Robbins out at one of his events, and he goes for 15 hours a day. So I was already well primed for the Investor Summit. So
you got a couple of takeaways for our listeners here from the summit. So I guess we should explain this is a real estate investors conference this is the 15th year. It's hosted by the real estate guys. Who also broadcasts on this station, and they since the crash, it is more and more shifted in certainly a significant part of the content toward the world, international investing, economics, that sort of thing. And real estate's still the core, but it's a lot broader now, and we've got a broader audience and faculty like Victor, who we benefited from having on this year. So with that little intro there, Victor, what were a couple of your takeaways?
There were really a couple of folks that really spoke to me very loudly. Simon Black is a brilliant man. He really connects the dots from studying history to what's happening in the current day today. If you haven't heard of Simon Black, look him up online, sign up to his blog. He has a real global perspective on business, on how governments operate, how banking operates. He opened a bank recently and had a lot to share about banking from the perspective of someone who owns a bank, not just someone who works in a bank, but someone who owns one, and had some very enlightening stories from that perspective. And then, of course, Robert Kiyosaki, who is a legend. We had the pleasure of celebrating his 70th birthday and the 20th anniversary of Rich Dad on the Investor Summit at Sea. And we participated in a 3-hour article study, very enlightening exercise. He's not an easy guy. He's a tough guy, and he really challenged people in the audience. I felt challenged, and I came away with a couple of really key learnings from that. I expect most of your listeners have probably read Rich Dad, Poor Dad and understand the ESBI quadrants: employee, self-employed, business owner, and investor. And what Robert taught during that particular segment was very powerful. The idea that most people are focused on what they want to have. And from backing up from that, they focus on what they need to do to have what they want to have. And Robert comes at it from a different perspective. He says, before you can do and before you can have, you have to be the person you need to be to do what you need to do to have what you want to have. So it's be, do, have. And he broke that down in a lot of detail for each of the 4 quadrants. Who do you need to be in each of those quadrants? And for me, perhaps it's an abstract concept, but for me, it really connected and something it's been ringing in my ears ever since.
Yeah, it's just like his original Rich Dad, Poor Dad book. There have been probably thousands of books written on real estate investing that talked about what color to paint a rental house and how to write solicitations on lined yellow paper, but very few on philosophy and paradigm shifts. And so, very consistent with his book was this 3-hour session that he had with those that chose to be there, which was, I think, everybody. And that's a tough session to have. It was a good paradigm shifter once again, wasn't it?
It very much was. One of the things that he really challenged many of the summiteers on is really to listen with both ears. A lot of people, when they listen, they interpret. So, for example, he used the example of air traffic control. So when air traffic control tells you climb and maintain 3,000, the pilot responds with climb and maintain 3,000. It's not, well, I think it's sunny, and because of that, maybe I'll go to 3,500. It's climb and maintain 3,000. And that came out loud and clear in the article study, is not to cloud what's really being said with our own filters and our own thinking. Separate yourself from your own story and really listen with both ears. That was a very powerful and at times difficult lesson to internalize.
Very, very profound. In fact, he calls up folks to the front and say, all right, what did the author just say? And everybody, virtually everyone, wants to color it, right? They want to color what it is through and put their own filters on it, and it comes out differently than what the author said.
Exactly.
And then it's okay to go back and say, all right, what's your thought about it? But the first thing you need to do whenever you're reading anything is to get what they were trying to convey. So what a powerful message, and who would expect that kind of philosophy to come from the guy that most people associate with real estate investing?
It's funny. Sometimes some of the most profound things are so simple. The idea of just listening fully, intently, and digest what it is that you just took in rather than filtering it. That's so simple, so basic. And here's a guy who's worth many hundreds of millions of dollars, perhaps billions, who is using that as a foundation for everything he teaches. Very profound.
Yeah. Well, we could do a whole show on takeaways and from it, and maybe we should do that at another time. But let's get into today's topic about let's work our way toward raising money. In the balance of this segment, give us a little insight as what took you from high tech to real estate.
Well, I think it was about my 18th trip to Tokyo in a year and a half. I was building a new cellular network with a Japanese carrier, and it was burning me out from a lifestyle perspective. And I was really feeling like the world of technology was very difficult to create wealth. It was kind of like saying I want to win the lottery when I grow up. There are too many startup companies, and I've been involved in several, that simply, even if they hit the home run, they couldn't survive as a standalone company 2 or 3 generations hence. They would eventually get gobbled up. So the days of building wealth in technology, unless you have the depth of pockets of an Intel or a Samsung or someone like that, really, really difficult, especially in hardware design. So I really looked around to see what else I could apply my skills to, and the world of real estate development just kept coming up over and over again. So it was a conscious decision. We fortunately had one of the gifts of a lifetime from an investing standpoint, which is the meltdown in real estate that took place in 2008. So it really created the opportunity of a lifetime for someone to get in at that time.
Good. And what did you get into? How did you start?
Well, I started here locally, like many people do. I live in Ottawa, Canada, and being the seat of federal government here in Canada, there's a lot of temporary people coming in and out of the city, whether it's embassy staff, parliamentary staff, military officers, and so on. And they're looking for short-term accommodation. They don't want to stay in a suite hotel. They don't want a 12-month unfurnished lease, and they don't want to stay in an Airbnb. And when I started, Airbnb didn't even exist. What they're looking for is a fully furnished turnkey apartment, and so that's what I started providing, specifically targeting that segment of the market. And it was a good business. It wasn't a great business, but it was a good business, and it gave me a very solid start and a solid foundation. From there, I moved into the U.S. market, started buying multi-unit residential buildings, doing a little bit of fix and flip, but really focused primarily on buying multi-unit residential buildings that I could buy below construction cost.
Okay. Victor, let's continue that when we get back from the commercial break. Got Victor Menasce with us from Ottawa, Canada, who just spent 8 days with us on the Summit at Sea and talking about his move from high tech to real estate. And then we'll talk about how to raise money for your venture. So stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So we have Victor Menasce with us today from Ottawa, who's the principal at U.S. Real Estate Partners. He went from high tech, as I did, over to real estate investing, and we were just talking about that sequence for him. And he went into multifam business in the U.S. And what did that lead to, Victor?
Well, we started doing some major renovations on buildings, principally in the Philadelphia market. And what we were buying is 100-year-old buildings, demolishing the interior and putting a brand new building on the inside, preserving just the exterior structure. So the leap from there to ground-up development was actually a very small step.
The preservation of the exterior, was that more for because it was cheaper to do it that way, or were there restrictions that forced you to do that?
There were no restrictions. It just turned out to be advantageous, easier to maintain the streetscape with the existing structure, and so it saved some cost, and it worked out. So that's where we started.
Okay.
We ended up acquiring a bunch of properties from some auctions with the housing authority, and I think we bought initially 15 properties. That way, it was our first foray into the Philadelphia market, all multi-unit residential.
And who is we, Victor?
I developed some partnerships, and I do this in every single market that I'm active. I develop partnerships with people who are local, boots on the ground, doing the hands-on management of the projects. I don't swing a hammer. I don't hands-on project manage any of the developments, but I am involved with the teams every day on the phone. But they oversee the local projects. My principal responsibility is to raise capital. That turns out is my gift. It took someone to tell me that. I didn't realize it at first, but that was one of the skills that I brought over from the high-tech industry, is the ability to raise capital. And I learned how to do that in tech startups, doing acquisitions, and discovered that was a very portable skill.
Victor, one thing that I've observed in my I think transition from high tech to real estate full time in the year 2000 is that I think that most people undervalue generally skills that they can carry from one asset class or one area to another. Would you concur with that?
I agree. And, especially in the world of real estate, if you look at most of the real estate training organizations out there, they tend to focus on the transactional part of real estate. Here's how you do a short sale. Here's how you do a wraparound mortgage, all of that kind of stuff. And frankly, real estate is just a business like any other. And if you've learned how to build a successful business, you understand marketing, negotiation, all those other elements, you have the elements of building a successful real estate business. And the folks that are successful are the ones who have those fundamental business principles under their belt.
So you've turned into the partners that you had in real estate, you then led toward the role of raising the capital. Correct.
What I discovered in the tech industry is raising capital. There was an art form to raising money, and it wasn't just did you have a good enough story. You needed a whole bunch of elements. And I found that those were universal. It didn't matter whether you were looking to raise money for a tech startup, a corporate acquisition, a piece of real estate, or even a charity. Those same fundamentals apply. And if you meet them, it's easy. And if you don't, it's real hard.
Mm-hmm. Okay. So you decided, so that's what led to writing a book?
It is. In fact, it's funny, I was writing another book, which is still in the works. The upcoming book is called Startupology, and the premise of that book is if you're looking to do a startup, then maybe there's a better way. I won't get into all of the details of that today, but as I was writing that book, I in fact was on a radio show talking about the fundamentals, and my business coach heard the interview and said, "Victor, you've got a book there." I said, "Yeah, I'm writing another book." And he said, "No, you got to write this one." So that was the genesis of Magnetic Capital, was that particular radio interview. And he was right. I outlined 13 chapters that night and, wrote the book very quickly after that.
Mm-hmm. So you thought it would be useful for others to know what you'd figured out.
Absolutely. And, I started teaching seminars on how to raise money because what I found was there was virtually nobody teaching this. The real estate guys have their syndication events that they teach, but there's really very few people in the industry teaching this, especially folks who have done it and done it successfully and really understand, from the school of hard knocks, what works and what doesn't.
Yep, indeed. Have Victor Menasce with us talking about how to raise capital and for anything, including real estate. So stay with us here on Real Estate Radio Power Investing on KDOW 1220 AM. The Wall Street Business Network, and we'll get into some more details about raising money.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Got Victor Menasce with us today in Ottawa, Canada, talking about how to raise money. He went from real estate from high tech to real estate investing to then specializing in how to raise the money. And he's written a book called Magnetic Capital, and we're talking about that. What is you told us that there's a lot of similarity between raising capital for high tech or real estate, but what's different?
I don't know that there's really a lot different. Maybe it's just emphasis between real estate and high tech, but the same fundamentals are in play. You really need to meet 5 things in order to raise money successfully. Number one, you've got to develop relationship, and I mean a genuine relationship with the folks that have the money if you're an entrepreneur. And it really starts at the relationship level. Most people are not going to part with thousands or millions of their hard-earned cash with someone they don't have a relationship with.
You mean people still buy from people?
Absolutely. It's the core. It really is. I mean, unless you're talking about, crowdfunding or a GoFundMe type campaign where relationship doesn't matter, you're not putting large sums of money at risk. But for real money, relationship is still at the foundation.
And I think that's why Wilson Investment Properties, 11 now going on close to 12-year brand. We have clients all across the country, but we still have our core is in the Northern California where we're located in Silicon Valley, because even if people don't actually meet you, they like that they can, and most of our investors we meet and get to know on a personal basis. Absolutely.
And I'd say it's the rare exception when that doesn't happen.
Mm-hmm.
So that's number one, relationship. Number two,
I guess. The other situation is probably if you have a mutual person that knows each of you very well. That helps, doesn't it?
Correct. But then again, relationship is getting bridged there because there's a relationship of trust with someone else.
Mm-hmm.
So it still comes back to that. So the second is trust, which is not just is this an honest person that you're dealing with, it's a whole series of questions like, can I trust you to put together a good plan? Can I trust you to execute it? Can I trust you to hire the right team? Can I trust you to communicate in an open and transparent way? And on and on and on. And if any one of those is missing, it actually doesn't work. It's a much more complex psychological contract than just, is this a good guy?
Yep, that makes sense.
Number 3 is track record. Show me that you know how to be successful. Show me that you know how to multiply money and that you've done it repeatedly. That's part of trust, but track record counts for an awful lot. Eventually, if you're not the real deal, time will catch up with you and your true colors will be shown. That doesn't mean that you don't make mistakes. It doesn't mean that you've never lost money, but it means show me your track record. Show me, warts and all, that you know how to navigate a business in good times and in bad.
And even if you have an honest intent, doesn't mean necessarily that you have a good track record. So you need to check that out.
Exactly.
Yep.
The fourth is, do you have a compelling opportunity? And that's a little bit in the eye of the beholder. So you've got to really understand what's going to be compelling for your funding source. Is it a 3% rate of return or is it a 30% rate of return? I know what my investment criteria is, but it's got to be compelling. And a lot of people focus on what they think is the most important thing, which is the deal, and it's rarely about the deal. That almost comes last. It's a requirement, but it almost comes last.
Let's go in a little bit more detail on that when we come back after the break. We have Victor Menasce with us in Ottawa, Canada, the principal at U.S. Real Estate Partners, talking about raising money for real estate investments or any deals. Stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Victor Menasce with us today, talking to us from Canada about the raising money for projects, including real estate, and just walk through the main principles of raising money. And on your last one, you just mentioned, Victor, you talked about it's got to have the right story and the right requirement for the investor, and often the person raising capital misses the target of what they're really looking for.
Exactly. And the way that I think about it, it's almost like a pair of shoes. You may walk into the shoe store and you may find a beautiful pair of shoes and, oh my gosh, it's your lucky day, they're on sale. But you know what? If they don't fit, you're not a buyer. It doesn't matter how lovely they are or how deeply discounted it is. You're going to have each investor, especially the more sophisticated investor, is going to have much more stringent criteria what it is that they're looking for. For one person, it might be storage units. For someone else, it might be medical office buildings. Beauty is a little bit in the eye of the beholder. And so what is compelling to you as the entrepreneur may not be compelling for your potential funding partner.
Well, it's sort of like in any sales situation, isn't it? It's you gotta not just talk and sell. You got to listen to see what they want.
Exactly. And the last criteria is what I call alignment. And these are a whole bunch of really small things that really together are essential. And it's not enough to hit on most of them. You have to hit on all of them. For example, you've got to hit on the size of the investment, the rate of return, the term of the investment. How long is the money going to be tied up for? What's the tax consequence? What's the control structure? What's the risk? What's the security? And so on. And if any one of those is missing, it doesn't work. So it's very seductive sometimes to think that you have something that almost works, because something that almost works actually doesn't. You actually have to hit on all of those criteria. So you make sure you try and get that out of the way fairly early on, part of the process of qualifying the conversation with your potential funding partner. Make sure there's a fit. Like I said, it's like a pair of shoes. And if the pair of shoes don't fit, nobody gets offended by that. No one gets weird about it. But when you start talking about money, all of a sudden people get awkward. There should be no awkwardness whatsoever. It just doesn't fit.
Very good points. And so let's see, did we cover the fifth one? Was that it?
That was the fifth one.
Okay.
That was alignment. Right. And you've got the more sophisticated investor you're dealing with, the more specific they're going to be on what those criteria are. Now, if you're a passive investor and you're listening to this saying, well, what does this mean to me? It's exactly the same criteria. It's the opposite side of the coin. That same fit needs to be there for you as a passive investor. So the same 5 criteria that I might need to meet as an entrepreneur, you need to meet as an investor. If you at least want to be a savvy investor and make good investments, you want to meet those same criteria from the other side.
So when Wilson Investment Properties started transitioning from primarily providing investment properties directly to our investors to providing shares and syndication of commercial and multifamily properties, I was not real sure how many folks would be willing to give up control and total ownership and go into a passive investment where they had no control, also no liability, and go invest in something that was totally passive. And to my surprise, many people were, as long as they felt confident with the relationship and the track record and so forth, as you just indicated. We've been pleasantly surprised how many people were very pleased to be more passive.
It helps from a safety point of view. One of the best things that can help any business is scale, size, momentum. It makes you much less vulnerable to little hiccups. It's the difference between owning a single-family home. If you have a vacancy, you have 100% vacancy. If you own a 100-unit building, now you've got 1% vacancy. You're much more resilient with scale. And yes, you have less control, but I'd rather have a smaller percentage of something that's lower risk and more successful than 100% of nothing.
So why do you think that larger scale tends to be less risk?
I think it's almost a universal law of nature as it relates to business. And, if you think about major companies that screw up all the time, think about your cellular carrier. How many times do they goof up every day? Thousands and thousands of times. And yet it doesn't kill them. It's because they have that scale, that momentum, that sustainability. As a small company, you're much more vulnerable as an independent player to even a small misstep. Scale helps you. It really does.
And our investors indeed really like spreading their risk by investing in multiple things quite fairly often. We've had investors that say, I really like this deal and I'd like to put in, $500,000. And we've said, tell you what, that's wonderful and thank you. But why don't you just put in, 100 and hold back the rest so that you can spread your risk. And they're amazingly appreciative of that.
That's exactly right. I don't want to take someone's last bit of capital ever. If they have $1 million to invest, I want to make sure that I represent a reasonable percentage of their total portfolio. I never want to represent the majority or 100%.
Yep. Very, very good advice. So you find that it's been fairly easy to get investors who are ready to be passive.
Absolutely. Look, there's a lot of people for whom the scarce quantity is not money, it's time. And, the wealthier people are, that's usually the case. Mm-hmm. I run into investors who say, I have a $5 million minimum because they can only do so many deals a year. Their scarce quantity is time, not money.
Mm-hmm. Excellent thoughts. When we bring Victor back after the wrap-up, for the wrap-up segment, we're going to ask him how you know if you're making a good investment. So we're pleased to have Victor Menasce with us today from Ottawa, Canada, who has told us about raising money, and we're going to have him right back here in a moment on Real Estate Radio Power Investing, KDOW 1220 AM. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So, Victor, talked about how to raise money, the value of scale, how you can help reduce risk, how passive investing can be very good, easier to deploy more money and to spread your risk. How would you tell someone to find out or figure out if they've made a good investment before, obviously, you get so far downstream you know it is or isn't?
I would apply what I would consider to be almost a life skill here as opposed to a real estate skill. Whatever it is that you're looking to do, get other opinions, but don't get opinions from your brother-in-law unless your brother-in-law happens to be a real estate developer. Mm-hmm. Get an opinion from somebody who, or maybe 2 or 3 people who are real experts in the area, folks that do this day in, day out, and get their perspective and understand it's just a perspective. It's only an opinion. The decision is yours at the end of the day. Even for myself as a developer, and I do this full time, I seek opinions from other developers. I offer them my projects. Not that I'm looking to sell them, but if they're not interested in buying them, there's information in that. Or if they are interested in buying it, there's information in that too. That tells me something. What do they like? What do they not like? I'm always looking to see what is it that I'm not seeing that someone else from their perspective might be viewing. And I'm always looking to do that with folks that know more than I do. And at this point, I'm a reasonably established, I would consider myself an expert in the area, but I'm by no means an expert in the grand global scheme of things. There's always people that know more. And that's who I seek out.
Isn't it great being open enough to recognize that you can learn something new, even about your area of specialty or expertise every day. I can't remember a day that I didn't learn something new.
Absolutely. And every single project has some nuance, some new surprise that's going to be a little different. Some of my mentors have done literally thousands of deals, and when I consult them on my projects, they say, oh, yeah, I saw that back in 1970, whatever, and they tell me what they did, and it gives me an insight, another way of looking at the problem.
Victor, thanks for being with us today. Highly recommend reading Magnetic Capital if you'd like some more information about the topic Victor's been talking about today. And Victor, if someone wants to reach you directly, how would they do that?
They can order the book. I urge them to do that at victorjm.com. That's victorjm.com. Or if they want to email me directly, I'm victor@victorjm.com.
So great getting to know you on the Summit at Sea and having you here today. We look forward to having you back on the program. Victor, thanks for being with us.
Always a pleasure.
And you always go to TomWilsonProperties.com for this podcast and others. Also, a lot of information about real estate investing in general. And also, if you sign up for a newsletter, you get access to products that are only available to our investors. And again, we always welcome your questions, indeed, and suggestions for future topics and guests. So thanks for being with us today on Real Estate Radio Power Investing on KDAW 1220 AM, the Wall Street Business Network. And remember, the only thing that matters is what you do next. Thanks for being with us.